Are you ready to turn your investments into retirement income? Listen in as Jeremy Keil and his guests reveal ways you can make smarter retirement, investment, and tax planning decisions to achieve your ideal retirement. You will learn more about your money so you can feel better about your money and make better money decisions. Now, on to the show.
Welcome to Retirement Revealed. I'm your host, Jeremy Keil, and I'm joined by my producer, Eric Johnson. Eric, how are you doing today?
I'm excited. I'm ready to learn. I like joining you. I love it when you have guests, but I kind of like it when you and I are interacting too, because I get to ask you the questions.
It's fun to talk more together. Yeah. Exactly.
That's right. All right. Speaking of, what are we talking about today?
We're talking about how the rich avoid taxes. So we might get slightly political today. I don't know how political we've ever gotten. This might get up to a little level of politicalness, maybe a 3 out of 10. We'll see how it goes.
All right.
But I read an article, and it said how the top 1%, dodge $163 billion per year in taxes. And I thought, interesting article. I got to read this. You ever heard of the term clickbait?
Oh, absolutely. Haven't we all fallen for that?
Yeah, I fell for it. It's a little bit of clickbait because I thought, oh my goodness, rich people dodging their taxes. I want to learn about this and see what they're doing wrong. And I read the whole thing, and every single thing they talked about is completely legal. I thought, you guys got me.
Yeah.
You guys got me. But these articles are out there, how the rich are dodging taxes, and I want to talk about that a little bit. And I want to talk about if there's some things we can learn from this that maybe the little guy can use to make the best use of how the tax code is written. Because that's really what they turned out they're talking about. They weren't dodging any taxes in any way. They're just using parts of the tax code that are completely not hidden. They're just right there. So easy to learn. So we'll just go through some of that.
Yeah, absolutely. No, I think there's a lot of frustration because it's all over the media. I mean, I've seen it just in the last 2 or 3 days. Oh, the rich only pay 8.2% tax rate where everybody else is at 21, 22, whatever. There's always something they're doing this to get our dander up. But again, like you said, it's completely legal. They know the system. They have accountants and advisors that help them do this. And yes, there may be more opportunities for them to save on taxes, being a little bit more wealthy, and some strategies that work only for people with a certain amount of money. I get that. And that can be frustrating, but at the same time, they're doing what they should be doing by making sure that they're saving as much of their money as they can. It's not like anybody who just wants to write Uncle Sam a check for fun.
Yeah, and it seems like you said, these articles, things on Facebook or whatever, just trying to get your dander up. And personally, I got nothing against the rich as long as they didn't lie, cheat, or steal. And of course, some people think the only way people do get rich is through lying, cheating, or stealing. I disagree with that notion, and I'm just wondering if you feel that way. Do you feel like your life is better or worse because Patagonia or Apple was founded? And yet here are the people that are the founders of Patagonia, Apple, all these different companies that people know and love. They found a company, they get rich from it because everybody finds value in that company. They're buying things from that company. So it's just an interesting mindset, I think, sometimes. But we're going to link to some of the different areas. That there was a report from the Treasury that did not at all say tax dodge like the article did. And then there's another article that we're going to link to about how that 1% dodge, that's the one I saw originally. But then it was an interesting article is they said, well, here's how they avoid this tax dollars. And I wanted to talk about that because I'm just curious going through it if people feel like this is actually a wrong thing, avoiding tax dollars is a wrong thing from what we're going to end up talking about, or is this something to learn from? And maybe we ought to be looking at some of these different things.
Absolutely.
So let's go through it. So number one, people should pay what they owe and not lie about their income or the tax laws. I just want to get that out there. That's how I feel about it. And I also feel that when these articles are talking about avoiding taxes, it was just sensationalism. It turned out, and we'll go through it, turned out everything they talked about is completely normal, just completely normal, above the board kind of stuff. And here's what they're talking about. The first way that allegedly the rich avoid taxes is they said they pay lower taxes on dividends and gains than on their salary. And so that's just an interesting tax code. And some of the tax nerds out there are going to love this, where they see reports, and people that aren't tax nerds, they see this. What does this mean that the regular workers pay more in taxes than the rich people pay on these dividends and gains. Well, a dividend or a gain happens when a company makes money. When companies make money, they pay a tax on their profits, which is roughly 21%. Let's just go with that number because that's about what it is. When you're a rich person and you get that dividend or gain, then you pay a tax on that called the long-term capital gains rate. It's maybe 15 or 20% or even more. So when you see that these rich individuals are only paying a smaller tax rate, the articles are only looking at half the taxes. The company paid tax at about 21%. The rich person paid tax at 15 to 20%. That means the total taxes on those dollars are between, let's just say, 35 to 40%. Let's just go with round numbers. That's a big number. Now let's compare it to the salaries. When a company pays out a salary, the company doesn't pay any taxes on that salary because it's an expense for them. They don't have to pay taxes on something that wasn't a profit. They only pay taxes on things that are a profit. And when you are someone, let's call them rich, when you're rich in this definition, I'll just say you make over 100 grand roughly per year as a couple, which is probably about, middle-ish of the road there. Well, those salary taxes are at 22 to 37% taxes when you're rich. When you're below that 100,000, your salary taxes might be at 0 or 10 or 12%. And then if you read in the articles, sometimes you hear about the FICA taxes at about 8%. We'll get this in the show notes to show you the math because we're talking here in audio. But the point is, at the maximum, if you're not quite rich, you're paying maybe 18%, 20% on those salaries. Meanwhile, these dividends, these gains are being taxed at 35 to 40% on that dollar because half the tax came through the company and roughly half the tax came through on the rich individuals. That's just, like we said, that's just sensationalism where they're only focusing on half the tax and comparing it to a full tax on the other side. You got to look at the full tax for these dividends and gains, and they're basically the same, if not higher. These dividends and gains come in at a higher rate than the salary does. So I just hate seeing that argument because it's just bad math, and they're choosing to ignore what reality is when they're talking about these different articles that are out there.
Well, it's a lot easier to get people to read when you get them upset first.
And I'm hoping people aren't quite upset about how we're talking about some of these things are, but please send us an email. I'd love to hear what your thoughts are. After you read the article, read kind of our thoughts on some of it too. Love to hear from you. It's Jeremy at KeilFP, KeilFP.com. So it'll be fun to interact and get someone else's take on this as well. So here's the number 2 way in the articles that they say the rich are avoiding their taxes. And they say, well, they are borrowing money. So if you are rich and have a lot of assets, you can borrow money. And of course, you don't pay taxes when you borrow money. And somehow that's a bad thing. It just seems interesting. I'd like to think about what would happen if maybe the tax laws were changed so that when you did borrow money, you had to pay taxes on that. Because right now, if you borrow money, you don't have to pay taxes on borrowing that money. So let's think about it. That's actually how your mortgage works. You buy a house and you take out a $300,000 mortgage on your house. You don't want the government taxing you. And so if you're taking money out as a mortgage and not getting taxed on it, why would somebody else need to get taxed on borrowing money on that? So it's interesting how they take this normal thing. Borrowing money is somewhat a normal thing. Not paying taxes on the borrowed money is completely normal. No one's doing that. It's interesting that they can take that concept, which everyone's used to, and somehow twist it to say, well, it's a bad thing when someone who's rich is borrowing money, but it's not too bad when someone who isn't a billionaire is borrowing money for a mortgage. It's just interesting to me. Well, number 3 pops up and it says giving their money away. And I said, wait a second, we're mad because the rich people are giving their money away? Isn't it kind of like if you're thinking that people that are richer owe something to society, shouldn't they be giving money away? I mean, that's a great thing. And so that's interesting how they say, hey, they give their money away, and that's almost not fair because they get a tax deduction. Well, guess what? A tax deduction might save somebody, I don't know, 20, 30, 40% of whatever they gave away. When they give the money away, they gave all it away, right? You give $100 away, that $100 is gone, and you get a tax deduction, and maybe they save 20 or 30 or $40 on their taxes, whatever it is. they still have less money than when they started, right? Good for them for giving away their money. I think it's actually a great tactic. If you're someone that's not a billionaire, I'd like to know if there's any billionaires listening to our podcast. Please send us an email. Love to say hi.
Yeah.
But if you're not a billionaire, maybe we ought to follow these tactics. This is a great tactic. People ought to be sending money that they have, that they're blessed with, to people that need it. And so that's a great thing. And it's kind of nice that there's a tax deduction that's on there. Now, let's talk a little bit about tax deductions, because it'd be good for us little guys, right? The people that maybe aren't billionaires, to get that same type of tax deduction. Love you to still give away some of your money. Why not get a tax deduction for it? For this year, it's 2021. If you're single and you give away $300, you can put that on your tax returns as a deduction. If you're a couple, you're married filing jointly, you can do that for $600. So that's a nice little thing that you can get a deduction on that. That's kind of new in the last year or two. There are some tax laws that changed. Yeah, that's new. Yeah.
Okay, that's good to know.
Yeah. Take a look at it. I got a feeling, Eric, because I know who you are. I got a feeling you're maybe giving away more than $600 every year.
Oh yeah.
But make sure you tell your accountant that you are.
Yeah.
Right.
Exactly.
So you can get that on there. Another one. Now I also know you, Eric. I know you're not 70 and a half yet.
Not yet.
But some of our listeners are. And when you reach 70 and a half and you have an IRA, there's this thing called a qualified charitable distribution. Now, that's been around forever. That's been around since 2009, roughly. And that's the idea that if you have IRA money, you've reached 70 and a half. So that used to be the age where you're forced to take the IRA money out. Now that age for required minimums, they call it, from your IRA money is at 72. But if you're 70 and a half, you can take money from your IRA directly to the charity, send it directly to the charity. It kind of like skips your tax return. And so a lot of people look at it and they say, well, if I took out $2,000 and I gave it to the charity, I add $2,000 onto my income, I take a $2,000 deduction, it kind of washes out. Is that right? And the answer is absolutely no. It almost never washes out. This qualified charitable distribution, when you're 70 and a half, is a great way, if you are a giver, and if you're not, we'd encourage you to be, to say, take the money I would have been giving anyways, give it directly to the charity, because if it doesn't show up on the front page of your tax return, that helps out in so many different ways. It helps out with maybe some of your Social Security doesn't get taxed. It helps out with perhaps you don't pay extra for Medicare. It helps out where maybe some of your dividends and gains that you might have, if you're 70 and a half, you might have been a saver and investor, and you might have dividends and gains on your tax return. And that might help reduce some of the taxes on there. So it's a great thing to be looking into, to say, if I'm 70 and a half, IRA money I'm giving away ought to go directly to the charity compared to IRA to you, to the charity. That's something that we want people to be looking at.
No, I mean, those are great points, Jeremy. I think that when people see that, or they're giving away their money, the rich people are giving away money so they can get tax deductions, it's kind of not fair. I would challenge you to ask any charity that is receiving those donations if they're okay with the rich people giving away money to get tax deductions. Because without those large donations, I mean, we all do our part in a way. We do what we can. I mean, you mentioned that you think that I probably gave away more than $600. We have, but I certainly haven't given away $50, $60, $70, $100,000 or $1 million by any means, because I don't have those funds. But the rich people do. And so I'm all about encouraging them to give to charities, because charities do such great work in any fashion. So
You get it.
Yeah.
Good. Well, let's move over to the fourth way that the rich avoid their taxes. And this one, when the word avoid comes up, I thought the first three were completely bogus. This one might not be so bogus. Now, this one, I got a feeling this is why they saved. I would have put it first because it was legit on there, but I can kind of agree with this one. There's these types of trusts. They're called dynasty trust, grantor retained trust, all these different types of trusts that are written up basically specifically just to avoid taxes. Now, it's all completely legal, but in my mind, going through it, and you can look at the article to read all about it, but in my mind, if they're going through saying, how do we help the rich pay more taxes, using fake math or half the math on what dividends and capital gains are charged for tax rates is kind of dishonest. To say, oh my goodness, I can't believe they're borrowing money and not taxed on it, that's what everybody does. That's called a mortgage. I don't think that's a big deal. To give their money away and say that they're getting this huge benefit, they're losing more money by giving it away than whatever tax benefit they might be getting. And like you said, anything we can do to encourage anybody to give away money is a great thing. But we get to the fourth step where there's all these different trusts that are complex, only available for the rich to avoid taxes. You know what? I'm not a politician. I don't want to be. But it seems like that might be the one legit place to start looking at. And there's an article put in there of how the people that founded Facebook, these Facebook billionaires, they gave away a bunch of their money, like millions upon millions, maybe even billions of dollars. And they put on these low prices. They said, oh, Facebook's going to have an IPO next couple months from now. And so let's give away the money now. And well, it's tough to sell billions of dollars of Facebook stock. So maybe it's worth like $1. And then all of a sudden IPOs 2 months later at like $20. Okay, that seems kind of shady for the people that are founding these big companies, and they know what's going to happen in a few months, and they make up a number for what things are worth, where it's worth way less than it really is. That seems a little bit shady. So I'd love for all these articles that say the rich are avoiding taxes, maybe focus on that part, the one that's legit, as opposed to just the normal stuff of you get a tax deduction for giving your money away. I hope everyone's doing that. I'm
really confused by what you were just sharing. I know that you said there's an article that I'm going to go and read, and I think we're going to link that in the show notes. But so give me an example. So you're saying that they're allowed to set their own price for what they're saying, its value is, and then when it inflates, it's a much larger tax deduction. Is that how that works? That's the way it seems. Where you say, "Oh my goodness, how do you value like 3% of Facebook?" Well, it's tough to sell 3% of Facebook, so it must not be worth that much. 3 months later, 6 months later, whatever it is, it's really easy to value it because it's on the public stock market. So that's kind of apparently a normal thing to do, to say, "Oh my goodness, we've got this company that's huge, that actually does have valuations already, but they figure out ways based on all the tax laws that are written to say, oh, it's actually worth pennies compared to where it's worth dollars." Yeah, that seems a little shady. I would, but it's all legal. It's all legal. And so that seems like a good place to look to actually change some of the tax laws, is to get rid of the shady stuff. Yeah, it's not like I can say, hey, I gave away $6,000 to charity this year, but I truly believe that $6,000 is worth $50,000. That's what I think it's worth. So I should get the tax deduction for that. That's how, who makes these rules? I know. I can't blame people for getting mad about that one. And again, it's completely legal. So that would be more of a political way to change those laws compared to, is this a fair situation or are they cheating things at all? We want everyone to take a look at this. Love to hear your ideas, whether this is fair or not, whether the articles are just straight sensationalism about how people are dodging billions of dollars in taxes. And perhaps this last one, this dynasty trust and grant or retain trust, I mean, these just sound fancy, and that's sometimes an indication that things are a little bit different on there. But hey, we support people paying their fair share. We don't think anyone should lie, cheat, or steal to get rich or avoid taxes. But to call out these rich people and make them the bogeyman for just whatever is wrong in the world for just normal legal stuff, that just makes no sense to us. And we want to talk it through and say, here's what we saw, here's what we're thinking. And hey, maybe if you're not a billionaire, you can learn a thing or two and try to get some of those tax deductions that are legit too. Again, so many times they're painted poorly in the media, but I believe it was Warren Buffett that actually came out and said that it's not right that he pays less in taxes as far as percentage-wise than his administrative assistant. Yep. I think he's one of the ones that said that, and I love it that there are some rich people out there that are willing to speak up and say, hey, things need to be fixed. Now, does that stop him from using every possible law and loophole and everything else that's written in the tax code? I'm sure he does. No, I mean, he does, because he's brilliant, and everybody should use everything that they can to save taxes so that they can better their family or better their business. But I would love to hear from more uber wealthy people saying, let's fix the tax code, because I don't hear it from more than maybe Warren. There you go. Maybe I've missed it, but I certainly haven't heard it from Zuckerberg or any of those other guys. Well, they're the ones using it. I'm sure Warren's used these different trusts as well too. Not that I would know for sure, but hey, that's the place to look. Look at these different trusts and the tax codes and the laws written around that. And for all of us, I want everyone to take a look.
give more money to charity and make use of those tax deductions that are out there. $300 or $600 if you're a couple, you reach 70 and a half, you get this qualified charitable distribution. I think that would just make the world a better place if we go out and give money to charity. And don't forget then to check a few boxes so that you can save some of those tax dollars at the end of the year. Because, hey, that might give you more money to give away to charity yet again.
Yeah, absolutely. And I know you've already said it a couple times during this podcast, but can you please remind everybody what your email address is so they can email them their questions, concerns, comments about what you're talking about?
Yeah, I'd love to hear from you. It's jeremy@keilfp.com, JEREMY @KEILFP.com. Send me an email. Love to hear your thoughts on it, and want to say thank you for those that contact us, and thank you too for all the listeners to the Retirement Revealed podcast. We believe if you know more about your money, you will feel better about your money, and you will make better money decisions.
Thank you for listening to the Retirement Revealed podcast. Click on the subscribe button below to be notified when new episodes become available. Visit retirement-revealed.com to learn more. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Keil Financial Partners. Keil Financial Partners does not provide legal, accounting, or tax advice. Consult your attorney or tax professional. Representatives have general knowledge of the Social Security tenets. For complete details on your situation, contact the Social Security Administration. Keil Financial Partners is a part of the Thrivent Advisor Network, a registered investment advisor. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.